If you look at the rental rates, apartments on average across the country are averaging about $1 to $1.10, and we're between $1.12 to $1.15. So self-storage actually gets more money in rent per square foot compared to apartments, and our expense ratio is about 20% less. It's a beautiful model within real estate.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Mike Murphy at JB Harrison Insurance, helping real estate investors to understand and choose their best options for all their insurance needs. Call 616-868-0050 or email mikem@jbhins.com. Hello and welcome to episode 159. Today, we're going to be talking about an asset class that I love. It's one where you have renters, but they don't live in the property. You quite often don't have to worry about heat or water, and when someone moves out, you can sweep their unit clean and move someone else in the very same day. I'm talking about self-storage rentals, and my guest today, Scott Meyers, is an expert on the subject. And he's going to show us how they can be a great way to create massive cash flow without all the downside associated with residential rental units. Scott will also be one of our featured speakers at the RPOA's Michigan Landlord and Real Estate Investor Free Conference and Expo, which is happening here in Grand Rapids, Michigan, February 21st through 23rd of 2019. It's the largest landlord and real estate investor conference in the Midwest, and you can go to rpoaonline.org to register for free. Scott, I'm really looking forward to hearing you speak on self-storage investing, and I want to thank you for being on the show today.
Hey, my pleasure, Brian, and looking forward to getting back up your way and chatting today as well. So thanks for having me again.
Yeah, well, thank you. I know that you don't do this very much anymore. You are the expert on this subject, and it's rare to hear you speak on it anymore. Is that the case?
It is. I enjoy doing podcasts, and I still like to go out and attend some large events, but mostly now with trade shows, and then other larger events like yours are what I've kind of pared it back down to now. I've got kiddos that are getting up in age. I don't want to miss anything in their lives, and also on the investment side of the business, the more I get on a plane and go out just to speak, the less I invest. And so, yeah, we've been making hay while the sun's shining during this economy. So, yeah, I really scaled that back and just focusing on the investments and family, and then also just my own time.
Well, that's great. We're very lucky to have you then. Thank you. Why don't we start by just telling us a little bit about yourself, how you got started investing in self-storage, and a little bit about your background as well.
Sure. Well, I grew up in Michigan, born in Pontiac, and moved when we were 3 to Swartz Creek, Michigan, and went to University of Michigan. And then after I got a degree, I got a job with a Fortune 500 company that brought me down to Indianapolis. So right out of college, I came down to Indianapolis and started to look into the stock market and other ways to prepare for and invest in getting ready for retirement. And what I found is that, most people had not made their wealth for retirement in the stock market. They had done it in real estate. So I started buying anything and everything I could get my hands on to learn about how to invest in real estate, and bought the Carlton Sheets home study system and took off from there. Began buying houses, and we were mostly landlords at the time, so we would buy them, rehab them, refinance, pull cash out, go buy more, and offer them up on lease to own. We'd sell a few, mostly hold them, and then I got into apartments, and so we had about 400 apartments throughout central Indiana. And then after a while, just I think, as you know, Brian, just depending on how you do this, there's just the tipping point or a critical mass in which you need to get to, or you get these things paid off before they really cash flow. And I was getting a little impatient, and at the recession of 1999, when the dot-com crash occurred, and then the Community Reinvestment Act was put in place. Yeah, all our renters were taking advantage of that program and leaving, because anybody that could fog a mirror could buy a house, and who could blame them? So we struggled during that time in the landlord business, as many did. And I decided at this point, certainly didn't want to get out of real estate, but it wasn't providing the cash flow and the freedom that I wanted when I got into it in the first place. And so began looking at other asset classes, and really just all roads led to self-storage. And it is the beautiful, in my opinion, just the perfect business model in real estate, because you can, it has all the benefits of real estate: appreciation, depreciation. You can create value in them, but it doesn't have the downside of tenants, toilets, and trash. And even to dig down further into that, when somebody doesn't pay you, we have the ability to overlock them and then sell their stuff off to get repaid, which is under the lien laws, which is vastly different than eviction laws that we have in habitational real estate. So after learning more about and getting into then the self-storage business and buying my first facility, I divested of all the other houses and apartments, and now this is all that we do. We just invest in self-storage and have since 2005 is when we began. 2006 is when we sold everything else off, and then gotten into developments and acquisitions now nationwide. So it's grown quite a bit since then. And I only own one house now. It's the one I live in. And never say never, but I can't see me doing anything else other than self-storage right now. We love the asset class.
Wow. So you're all in on self-storage since 2005. How big is your portfolio?
We've got approaching over 30 projects now. And I say over 30, I should know the exact number. It's not that much, but we've got developments coming out of the ground, and so those aren't fair to call them completed yet. We've got conversion projects in Kalamazoo, Michigan, as one of them that has just come online recently. But over 30 projects and approaching 7,000 units nationwide.
Okay. Wow. So there's a lot to talk about there, because you're buying existing and you're building ground up as well.
Correct. Mm-hmm. Yep.
How about for our listeners, we start with the basics? I mean, what do you look at when you talk at self-storage? Because I know with apartments and multifamily, you're talking per door cost, unit per unit
right.
cost. What do we really pay attention to with self-storage?
Yeah, that was probably one of the biggest, if you want to call it, mind shifts, Brian, was always looking at units and or doors and basing everything on that. And in self-storage, it's all based upon square footage. So from development cost to what we can acquire it for, because we compare that to, if we can buy an existing facility with an income stream already in place for, north of, say, $35 a square foot. Well, it costs about $25 to $30 to build it, so that's one of the determining factors. So that's typically what we're looking at. But then, as you know, the great leveler, if you will, in all investments on the income property side is a cap rate, and so we're always looking at cap rates to see where it's at and where we can take it. And typically looking at distressed stuff. We're all about value add, just like we always have, from houses to apartments to self-storage, and even our office buildings that we own as well, and bigger warehouses. Where does it sit today? And what is the future value of it? And then can we buy it today for less than the cost of replacing it or building from the ground up? Those are, the determining factors that we look at when it comes to, purchasing or then developing a facility in a particular market.
And it seems like, since you're doing both, there are areas where you're able to build brand new for less than the cost of existing product, but then it sounds like you're also finding existing product that still makes sense. Correct.
Yeah, and it's and that's all a function of the rental rates in that particular market, and that's what's going to dictate whether we're going to build or not. Some areas, if the rent's low, it just doesn't pay to build. The cost will never get covered. As our consultant says, you can get the land for free, but it's still not going to work because the rental rates aren't enough that once you get it stabilized, they're not going to cover it. And then in other markets where you would think, oh my gosh, $500,000 an acre, there's no way that this would work. But then when you look at going north, meaning building up multi-story, and the rental rates in a market that is had a moratorium or has been completely underserved for several years, in a market with high rental rates for storage, and it makes sense all day long. So it's math. It's a real estate math. It's self-storage math, and just reverse engineering and working backwards from what would this thing look like in terms of a net operating income when stabilized, and then compare that to how much it would cost to get it there.
So what are some of the other factors you look at when determining whether or not it makes sense to purchase or build?
Yeah, it's no property is, no matter how low of a cost you can acquire it for, or a great project in terms of a construction, and it would work very well in a market without looking into the market. So we look at a supply index. There's some numbers in self-storage that are pretty standard. That it's not a simple business. It's certainly not an easy business, but it's predictable. That's the one thing that we have going for us, and that we know that if we go into a market, and within that market, our sub-market for a particular project, a facility that we're going to buy or to build, if we draw roughly a 3-mile radius around that is our market. That's our sub-market. And so within that 3-mile radius, let's say we found a facility that is 60% occupied, it may be underperforming, and we look into the market and we find that the competitors in that 3-mile radius are all 90% full and they're $10 higher per month in rent, then that's probably a strong project. But most importantly, we're looking at the supply index, which means we compare the amount of square footage of self-storage in that market currently, and divide that by the population. And so we look at a square foot per capita. And in the industry, depending upon who you talk to, the range is anywhere from 6.5 to 7.5 square feet of self-storage per person. And so if we do our market study and we find that there's 4 square feet of self-storage per person, we know we got an underserved market. And not only would we buy an existing facility all day long there, but we'd also look to build in certain around that 3-mile radius if possible. If we're at 10 to 12 square foot per person, then that this piece of dirt that we're looking at to buy, even though it's very inexpensive and zoned for storage, no project would work because it's an oversupplied market. So the deal's got to be strong, but the market is the main indicator in terms of supply index, and then again rental rates that are already existing in the marketplace from existing competitors.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. And be sure to stop by their booth at the RPOA's annual conference. Do you have a rule of thumb that you like to see, like as far as how many people you want to have within that 3-mile radius?
Yeah, not necessarily a number so much as looking at the supply index. So some developers, including ourselves, we like to see a populated, high density in a populated market. So north of 80,000 people within, say, a 5-mile radius, and then we kind of peel it back from there. But again, Brian, we're really looking at what's the competition there? How many square feet are already serving the people? Say there's 70,000 people in a 5-mile radius. How many self-storage facilities are there, and is it already oversupplied, or is there still an opportunity, or is it very underserved and nobody's come into that market yet? So it's twofold. It's the overall number, but then how many competitors, competing self-storage facilities are already in place in that market?
Why don't you take us through like one of your deals just to kind of illustrate what we're talking about? And if you don't mind, let's start with an existing facility that you might pick up. Mm-hmm.
Yeah, the business model has been pretty much the same since day one, Brian, and that is, we will go into our sandbox that we play in, as we call it. Or it's not the top 100 major metropolitan statistical areas. So we're not in the Miamis, we're not in New York, we're not even in Indianapolis. We are in the donut cities and counties, so just outside in the suburbs and the secondary locations, secondary cities, secondary populations. So that, first of all, and we're fine. We'd like it if the big guys, the REITs, the real estate investment trusts, so the public storage, the U-Haul, the Extra Space, if they're in our market, if they're creeping in there because they raise rates, for everybody, which is fantastic. But we don't compete directly against them. So we operate in the areas outside of the major cities. Land is cheaper. Zoning is easier to get for building or converting. And it's just much easier to operate a business in those areas. So that's first and foremost. And second of all, what we're looking for is our goal in typically, well, in the beginning, it was buying a facility that, again, was value add. So we'd like to find a 4 or 5 acre site facility that only has buildings on, say, 3 to 4 acres, meaning that we've got another acre that we can add on to. So hopefully, again, value add is what we're looking for. Hopefully be able to also turn around the management of that site, meaning running it more efficiently, utilizing technology so we can reduce the manager's hours, we can raise rents, and then fill up the existing units and cure any vacancies or accounts receivable that we may have. And then at that point, when we're stabilized at 85 to 90% occupancy, then begin building on, put another building or two up on that additional acre, because that's where we really create the value. So not much different than when we're looking to develop in terms of, we're looking for a parcel that we can buy inexpensively, but the rates are, again, really strong in that market. And then put together a budget as to what it looks like to either build single-story, non-temperature controlled buildings, or if the market is calling for temperature control, then we may go up and build what you see as the Class A multi-story self-storage facilities that are temperature controlled and have all the amenities and a business center inside, and look every bit as nice as any of the other retail businesses or establishments around it. So those are the things that we're looking for. Again, just all about value add. We use private equity investors in virtually all our deals, and so there has to be a tremendous upside in order to split the equity with our private equity investors and have enough profits for both.
When it comes to rental property insurance, understanding the costs, choices, and benefits can be overwhelming, and finding the right insurance provider can be frustrating. I had one company cancel 5 of my policies all at once for no good reason, and that's why I'm happy to have Mike Murphy from JB Harrison Insurance on my team. Mike is an independent agent who has always been able to find the right policy and the best provider for my insurance needs. Over the past 5 years, Mike has not only become my go-to insurance agent, he's also helped me manage risk, add value, and save money. If you are looking for insurance on a new acquisition, or you believe it's time to get a more comprehensive look at your entire portfolio, then Mike Murphy is the independent agent to call for all your insurance needs, auto, home, and business at 616-868-0050 or email mikem@jbhins.com. Sounds like you have a system and a formula, and it's all very mathematically worked out. Why don't we take a step back and just talk about the fundamentals? Like why invest in self-storage in the first place?
Oh, wow. How long do we have? Do we have 2 hours, 3 hours? Is that what you said?
Well, when you come to the conference, you'll have 2 hours at least. So, but just give us kind of the overview. Like, why is this a compelling asset class?
Yeah. When I began looking into it, Brian, is, my back was against the wall. First of all, it was coming out of that recession of actually right in the middle of it, 1999, 2000. And when I began looking into the business model, I just realized that, okay, what we commonly, or what people commonly look at as the Cinderella of the real estate asset class, or the stepchild before it became Cinderella. They thought, why do I want to invest in these metal boxes on concrete slabs, until I looked into the business model. And so, in no particular order of ranking, probably first and foremost is that there wasn't a lot of competition, before, and I have led to a little bit of competition, I would say, on my end, but there was not many people looking into it, and so it was kind of wide open, and there was a number of these facilities out there, these mom and pop facilities that could be purchased, basically, still utilizing the same principles that you and I and the listeners use, Brian, in contacting on like we would with small apartment homes and single family homes or small commercial buildings. These are mom and pops that were running a business, sometimes well and sometimes very poorly, that we could just strike up a conversation with, send a mailer out. We do our blind mailers and we get calls back, or we'd follow up with phone calls, and, we're negotiating with these folks on commercial real estate, and they're the same types of folks as we are, mom and pops running a business. But then when I dug into the business model, when I realized, as I touched on earlier, is that, in self-storage, we've got the protection of lien laws versus eviction laws in self-storage. So with the lien laws in self-storage, if they don't pay you, then we have the legal right to lock them out, put an actual lock on their door. There's a place for 2 locks on the doors of self-storage doors. And then we have the ability to remove their gate code if there's a fenced facility with a gate code, and they can't get in until they pay their back rent and late fees. And then if they don't, we go to auction, and that's which has spawned all the popular shows on cable. storage wars and auction hunters and the like, and we can sell their stuff off and get paid, and then either that person becomes our new tenant until they get everything else out, or they move everything out immediately, and we move in the next person waiting in line. And our turns, my average turn, and this is going back 10 years now or so. Our average turn in our apartments or houses was like $1,300 to $1,500, meaning lost rent, including lost rent, and then rehabbing it, whether it be replacing carpet, cleaning it, painting, everything else to get ready. About $1,300 to $1,500. Well, when I turn a storage unit, I don't have all that stuff inside. I basically sweep it out or use a blower. I don't. The managers do, and then we move in the next person waiting in line. And there's just been a huge demand for self-storage as we went through this last recession. The development dollars stopped like they did for apartments. Banks weren't doing speculative development deals. And yet the need for storage, the demand for storage goes up dramatically during a recession. Because people are downsizing, businesses are downsizing, and so we had this perfect storm coming out of this last recession, and in this unmet demand. And so there's just a huge amount of demand for self-storage. It continues to grow. We're well underserved and undersupplied in the across the entire country, let alone every market. When people don't pay, we don't evict them. We lock them out and then we sell their stuff off. And what we get back is not damaged. It's a metal box on a concrete slab. So, there's a number of other reasons why I love it, but boy, those are the main ones right there. Because compared to where I was as a landlord, honestly, I don't care what anybody says about a property management company. At the end of the day, I still got to write that check, and I still have to deal with the calls about people just doing things that they quite honestly, I shake my head as that they shouldn't be doing. And we've taken that human element out of this side of real estate, and now real estate's fun. This is the way it should be. We get into rental real estate to provide real estate, to provide an asset that people rent out and pay you for. And there's just so much more that goes along with that when we have houses and apartments that, it'll burn people out. We used to buy their houses and their apartments because they got burnt out. But in storage, you don't find too many burnout owners because they don't get burned out unless they just flat out are really, really, really lazy and don't want to work because there's not much to run on these things.
If you don't mind, I'd like to focus a little bit more on the supply and demand. I know self-storage was a strong asset class during the Great Recession because of what you said, people having to downsize and to store their stuff temporarily. Why has it remained strong, and why do you see it continuing to be strong?
Yeah, interesting question, because we're now at that place where storage does very well, Brian, during both good times and bad times. So during bad times, call it a recession, call it a correction. When the economy's not doing so well, businesses are downsizing and they put all their stuff in storage, sublease their offices out, and put inventory and cubicles and furniture in storage. Individuals do the same thing. They move back in with mom and dad. They move in with friends or what have you, and they downsize, but there's still stuff that they want to keep. They just can't take it to where they're currently living until things turn back around again. So for that reason, that's why self-storage does extremely well during downtimes. But it continues to move up and to the right when times are good, because in this country, we celebrate that. When things are going well, we buy stuff. And
so we buy by accumulating.
You got it. And we are the hyper consumers of the world. And, God love all of you out there that are listening, because on behalf of the industry, we thank you. For buying stuff and storing your stuff. That's what Americans do. We are pack rats as well. And so when times are good, we buy boats, we buy RVs that can't be stored, or we can't put them outside of our house or in the driveway. The homeowners associations won't allow it. And it continues to go, and we just buy more stuff. Even, the question has come up, well, aren't you worried about this generation, the millennials? They're minimalists. And to a degree, yes. However, they are living in smaller quarters, but they want the life's experiences. Well, life's experiences require stuff, mountain bikes and kayaks and camping equipment and anything else you can think of that usually doesn't go in a tiny house or a small apartment. And so we have seen no downturn during the good times in terms of demand for storage. And Brian, we're still, in terms of development, trying to keep up from the Great Recession, where we were woefully behind. $25 billion in development when we came out, call it 2013 or so, I think the last time that we called the end of that recession, if you will, and development starting to occur again. $25 billion in development of self-storage was needed just to meet the demand, and we're still not at equilibrium. There's still a waiting list because, again, we fell behind, and times are good. People are still storing stuff.
And it really seems like that demand in the A markets, the larger markets like Miami, like you say, you've got the REITs and the big institutional money going in there to build. You're focusing more on the secondary markets and tertiary markets as well.
So we're focusing on the secondary markets that are real close to the major MSAs, and again, they're markets in which. Well, let me back up. So in terms of a development, we're focusing on those markets that are just outside of the majors, so that we can build a 60,000 square foot or larger facility that is a Class A facility that will be attractive to the REITs. And so the goal is, now in some cases they'll buy it at certificate of occupancy, meaning we haven't even rented one unit yet, and they're paying full price as if it were leased up. In some of those cases, if they need to add product to their portfolio, or we know at some point, once we get it stabilized, that it will be a candidate to be purchased by the REITs, and we do that because the REITs pay a higher multiple, they'll pay a lower cap rate. Same thing when we buy an existing facility, we would hope that we can increase the value and the size by getting up to the place where it's above 60,000 square feet, which is kind of their sweet spot, which is what they like to buy. But existing facilities, we will go, some of our students are buying them in the tertiary markets. And when I say tertiary, that encompasses a lot. So I'll say tertiary, but not rural. It's tough to raise the value in any piece of property if it is out in the middle of nowhere when nothing is happening. There is no growth there. The competition out there, everybody's racing to the bottom and undercutting in price. That's it. You can't raise value in those markets. So we do invest in some tertiary markets, but it has to have some populace and some growth coming in that direction. Or we just got to get a really, really good deal on it, and we just by raising rates alone compared to the competition, that'll increase the value of the facility.
Let's talk about management, and if you don't mind, can you do it in a way where you kind of compare and contrast with management of residential rental properties?
Sure. So a number of ways of, if you want to call it skinning the cat, it's not the fun part of the single family rental side of the business for certain. The way I used to do it was I didn't do it at all. I had this arrangement with my wife where I would create the messes by the properties, and she would come behind me with the pooper scooper and pick up those messes, put operations in place, and handle either the management of those properties and or a property manager part-time that we had hired. And so, what's involved in that is just a lot of phone calls, a lot of hand-holding, a lot of babysitting, a lot of trips to court and letters being written, and it'll wear you out. If God love all you landlords out there, if you can slug it out long enough to pay off your properties or get big enough that you can hire at least a property management company, that's the only way it works. Otherwise, most people, as you know, flame out before that. So it's hands-on. It is an active income business, and really, Brian, at the same time that we were doing our best to create these systems and having our us running our business, moving towards a place where we were running our business instead of our business running us, was when I was introduced to Michael Gerber and his book The E-Myth, and getting away from that active income business, and just realizing. And again, and I guess I should say I'm not trying to poo-poo anything that anybody's doing out there. I've been on both sides. I've made money on the single family side, and apartment side, and I lost money on that side, and now I'm in self-storage, and so I look at it a little bit differently. But I'm not telling everybody that they need to get out of houses or apartments. But boy, I think this is an asset class you should look at, because on this side, on our side, it's when people move in, the average tenancy is about 13 months, and Brian, studies have shown that they only visit 3 times their unit 3 times during that time. Once when they move in, once when they move out, and maybe once in between, call it a holiday or something along those lines. And it's just stuff sitting there. We don't have to have a manager or us, writing letters on a monthly basis and telling them to, stop having their dog poop in the yard and quit, playing the radio loud, the neighbors are complaining, or, this or that, or chase them for money, because We don't chase anybody for money. If they don't pay, we lock them out. And if they want their stuff out, they pay us or we auction it off. I mean, it's as simple as that. So it literally, the difference is 90% of my headaches went away when we sold our last apartment complex, and it was just plain quiet around our office because systems run the business and we manage and tweak the system. We achieved the E-myth in real estate, but that could only happen once we changed the asset classes and moved over to self-storage from the active income side of the business, which is managing people and contractors and property managers and all the moving parts that go into the residential and habitational side of the business. And I got tired of being that quarterback because it was a losing team every single time.
If you don't mind briefly just explaining the E-myth, like what's the principle that you achieved,
Mm-hmm.
and then also what systems did you put in place to help you achieve that?
Yeah, sure. So if there's anybody out there, there may be one or two people left on the planet that haven't heard of Michael Gerber and the E-myth. But if you haven't, the E-myth is essentially, he talks about the entrepreneur. The entrepreneur myth is what the E-myth stands for. And the myth that I think the example is either a plumber or a painter. To be honest with you, I can't remember now, Brian, maybe you do, but he talks about the plumber that is really good at doing what he does and decides to start his own plumbing business. But at the end of the day, he can't hire enough people to do it well enough, and he still has to do a lot of the technician work, as Michael Gerber calls it, in his business, and then he cannot focus on the business of running his business. So the E-myth is all about learning and taking a page out of McDonald's book or any successful franchise, and you see that they have standard operating procedures for every single thing that occurs within a McDonald's and any other business that operates like a franchise or any well-run business. They have standard operating procedures, and the systems run the business, and then you pluck a person out and put a person back in if something is not working. So like a McDonald's, if an employee doesn't work out, and they have pretty high turnover in fast food, if the fry guy decides not to show up for work and they have to let him go, well, you know what, they'll put another person in place, train him on the system, in a day or two he's up and running. And of course, they don't wait for fries for 2 days. But the idea is you create a system that runs the business so that you as the manager of the business, you as the owner of the business, you focus on the things that are most important in running a business, which is tweaking that system, but then going out and growing it and scaling it. Looking for, and for us in real estate, it's finding the next property, finding private equity investors to provide the fuel to grow the business and scale it up. It's not spending the time in the day-to-day, which is painting or cleaning carpets, or heaven forbid people are out there still doing that, but then even doing the bookkeeping and running those all the other facets of the business, or going to court and meeting the contractors out there for work that needs to be done, and going through bidding processes. That's just something for somebody else to do in the real estate side of the business. But also in the rental side, when you're talking about homes and apartments. But on the self-storage side, we just eliminated those altogether. And the only thing to do is to collect rent, and that's an automated process using property management software. And we use kiosks as well. If any of you have seen the kiosks that are located at self-storage facilities, it completes the rental of a unit just like it completes the rental of a Redbox movie rental. It's not much different. This is a commodity type business. It's a low labor intensive type of transaction to rent out units. The marketing on our website is on all the time, and so we don't have to advertise when we have a vacancy. It's our website, and it's certain aggregator websites and places people can go to rent online or through their smartphone or at the facility using a kiosk. They don't even have to come in and talk to the manager who has limited hours on site anyways. So it's about as close to a turnkey rental real estate business as you can get. Very little human involvement.
What about expenses? In a typical expense ratio in multifamily apartments, it's going to be around 50% or more, depending on whether you're paying all the utilities. What are the expenses and the expense ratio in self-storage investing?
Yeah, we're at about 31% on average, and that's a function of as you know, evictions and collections are huge in the business. When you have a turn, not only have you lost rent, but then you have to rehab that apartment. So that's a big piece of it, but also the value itself. You build an apartment at over or around $100 a foot or over $100 a foot. When the tax assessor comes out, they assess it as such. And when you build a self-storage facility at $25-30 a foot, they assess it as such. And so we have lower property taxes. Yet, if you look at the rental rates across the landscape in comparison to the two, apartments on average across the country are averaging about $1.12 to $1.15 per square foot. And about $1 to $1.10, and we're between $1.12 to $1.15. So self-storage actually gets more money in rent per square foot compared to apartments, and our expense ratio is about 20% less. So that also was another very huge factor when I ran the math over and over and over again and looked at the numbers. It just, again, you can't beat it. It's a beautiful model within real estate.
Yeah, it's very compelling. I mean, other than the dealing with tenants and evicting them when it comes to residential rental, what are some of the other factors that keep your expense ratio low in self-storage?
We build these metal buildings and things just don't wear out. Our capital expenses, over the long haul, we've got HVAC units, which in temperature control that they need to be serviced and then need to be replaced from time to time. But, all steel buildings with steel roofs that last, 50 years on the roof. We may reseal the parking lot here and there, and the gate mechanism that operates the moving gate out front, or a digital keypad, may wear out after 15, 20 years. But, all of these items are 15, 20, 50-year items. We just don't have to replace carpet and drywall and holes and damage and, all the wear and tear because nobody's there. That's a metal box on a concrete slab. It's all built to last and it doesn't get used much. So therefore, the expense of the ongoing repairs and maintenance and our capital CapEx or capital expenditures are just minimal.
Yeah, plus you don't have the utility costs either.
No, we don't. I mean, again, if we've got temperature control, that's it. But we keep it between 55 and 85, and the cost is passed along to our clients. And then, again, outside of that, we've got some LED wall packs that go on the outside of the building for security purposes, and that's it.
Tell us a little bit about some of the students that you've trained and coached. Any success stories?
Hundreds. I'm very thankful that one of the few places now that I've pared back my speaking, I do speak for the associations, for the Self Storage Association and the ISS, and it's gratifying, Brian, as as an educator to see your kids grow up, and I get to go to the trade shows and I see dozens of my students there that we've helped to launch their businesses. But we did that by design because we changed our business model back in 2013, and that was a part of the reason why I am semi-retired and I don't go out and speak much is because we changed our education model to fit our investment model, and now we really only work with folks that we know that we're going to partner with. So the folks that we train and teach and coach and mentor are those that we know have a high propensity to succeed because we interview them. They're already semi-successful in running their other businesses or a real estate business. And once we bring them on board, then the goal is to not only help them to get to the finish line on their own and build their own facilities or acquire their own, but then the goal is to partner with them then on either that one, their first one, or their next one, or those after that, because we have the experience. We already have a team in place, so it's really easy when somebody finds a lead to plug into our system. But mainly, we've been doing this so long, and we've been raising so much private equity that we have a lot of private equity investors behind us that want to do deals, that love self-storage because the asset class is on fire, and it does outperform all other asset classes when it comes to REITs and investing passively. It just it performs very well. And so we have this hungry list of private equity investors that are throwing money into this space, and we're just trying to keep up and provide as many opportunities for them to invest in as possible. So we are pulling the folks, our students and our partners along with us as we climb the ladder, and as the industry continues to rise, they're coming along with it.
What are some of the returns that you can expect, either as the investor putting the deal together or as a passive investor?
I can really only speak to the passive side, and that is, we structure our deals as they're private placements, so they're Reg D securities. We file that with the Securities and Exchange Commission, and so our passive investors are buying into a security, so they get shares of an LLC, and the goal is to be around 20% and above, north of 20% internal rate of return on any project they invest in, and that's at today's interest rates. That changes, obviously. If somebody's listening to this podcast 2 years from now, that can be dramatically different. But that is the goal right now, is for those folks to earn somewhere between 20 to 25% internal rate of return. And our projects are usually 5 years, sometimes 3 if it's a turnaround project, but most of them are conversions and developments that'll take about 5 years before they're fully reach their value. And then at that point, they get the share of cash flow along the way. But then the big pop that they get is at the end when we split the profits upon a sale. Now, on the syndicated promoter side, just depending upon what the deal looks like and how it's structured and, how much value is created, then it's clearly more than 25% internal rate of return. And some of those end up in the 4 digits in terms of a percentage range, if that makes sense, if you do the math on that.
There's a lot of money to be made in self-storage, basically.
Correct.
For our listeners and for the people who will be coming to hear you speak at the conference, I know one of the questions is going to be just, how do you get into this? Because we're talking commercial investments. This is not, buying a single family house to flip or rehab. Mm-hmm. It seems like there would be a lot more money at stake. So is it more cost prohibitive to actually get into this area?
Yeah, Brian, good question. That's one of the more common ones that I get, and probably the biggest misnomer too. The beauty of self-storage, commercial real estate in general, but self-storage, is that we're buying an income stream, that is backed by this asset class, meaning self-storage. And so when you find a project and you then take this and present it and put it in front of the bank and or the banker, first of all, what they're looking at is 3 things. They're looking at the project itself. They're looking at the market and your business plan and where you're going to, let me back up. They're looking at the project itself right now, where it sits. Will it cover the loan on day 1 or 30 days after they close this loan? Then where are you going to take it? Where's the value add in this market? And then they're looking at you in terms of your history and your performance in the past on existing properties you've had, projects you've done in the past, or if it's your first deal in real estate, then, what does your resume look like? Have you done this with other businesses or in your own business? But what they do is that they place more value on the strength of the property than they do on the strength of the borrower, meaning banks always look at end game. They're looking at exit strategy and worst case scenario, meaning if everything goes to heck in a handbasket on this deal or the economy or the project, and we have to move, Bill out of this project, meaning foreclose, we get the asset back. What is that going to look like? And so they're looking at where it's at now, where we think we can take it, and then what they would do with it if they ended up with it on their balance sheet, regardless of Bill and what happens to him, versus a single family home where Bill is presenting this house to them, and they're really looking at him to be able to cover the cost. Can he cover the cost of this house? If things begin to go south and he gets behind on this loan, because he's probably behind because he doesn't have a renter in it, and if we take it back, we won't have a renter in it, and we're not going to get into that business, and we're going to have to turn it around, fix it up, and sell it or wholesale it off for pennies on the dollar. Well, banks love self-storage because it does so well, and they can easily put it into receivership and have a management company run it. If it does happen to go down in performance, then they will turn that back around and then they'll sell it, and sometimes at a profit. And Brian, it's very rare that we find self-storage facilities that have gone back to the bank, for that reason. It's very rare. The only times that we've seen them go back to the bank is not as a fault of the property. It was because that borrower was going through a divorce, or they had issues with another property, in their portfolio, and everything went down, and this got wrapped up into a foreclosure to, again, no fault of the property. Properties run along throwing out cash, just not enough to cover all the bad mistakes that this other, guy or gal had made, or if there were health issues or divorce or, something else that happened along the way. So folks, don't be scared about going to a bank when you have a commercial asset, because especially if you don't have a lot of cash and your credit is dinged a little bit. Now, the second piece of that is, okay, well, it means I need to have lots of commas and zeros in terms of a down payment. But as I mentioned earlier, the lion's share of our deals have private equity investors involved in this, and these passive investors are getting a greater return than they would in the stock market. It's backed by real estate, and they've seen what self-storage has done, and we have absolutely zero problem raising private equity for self-storage. There's no such thing, Brian, as swinging a dead cat on the internet, but I think everybody gets the analogy. You swing a dead cat on the internet, and if you're looking for the best real estate investment to go into passively, and again, all roads lead to self-storage. And so, we've got sites and a tab on our main site that talks about the industry and the performance and the returns in it, and that we do deals with our folks, and we have no shortage of people standing in line to invest in our deals, providing that down payment. And we've got less than $50,000 in our multi-million-dollar development projects because we will match what the lowest investment, the entry to get into our projects are with our investors, and that's all that's required, because the rest of it is, we're bringing the project to the table, and everything else that goes into that are not only our sweat equity, but the brainchild behind it and the team behind it. So if you're struggling to grow a real estate business currently, you may also want to look at this asset class, because the banks love it and private equity investors love it, and you'll have no problem getting money to do more real estate deals in this asset class.
So it really sounds like if you're starting out as an investor, you don't have much money to put in yourself. If you find the right deal and you go through the right training to learn how to put a deal together, you should have no trouble finding the money to do it.
That's the idea. Having dinged credit and very little cash is no excuse to not go out and start this business.
It's the beauty of real estate investing.
Isn't it?
Yes, it is. What about markets? I mean, what markets do you like? What are the best ones to be investing in?
I was wondering when you were going to ask that, Brian. Where is the proverbial, where is the self-storage Oz, where all the streets are paved with gold and you can raise rents all the time and nobody's looking? It doesn't exist. It's in your backyard, though. Everybody wants to look to the best market or underserved market for real estate in general, or self-storage. But as I mentioned before, our markets for a particular project or facility it's a 3-mile radius of this facility that you're looking at, or a piece of ground, or the old bowling alley that you're looking to convert into self-storage. And we do the numbers on the market, the supply index. What is it undersupplied, and then what are the rental rates from the existing competitors that are in the market, and then just working backwards from there, just reverse engineering, working the math backwards from there. And so within a 2-hour radius, you're going to find a project. You're going to find an existing deal to be able to invest in. It may not happen right away, but that's where you begin to look. And then outside of that, as I mentioned, we train people to go out and find these projects all over the country. And then when they find too many, or one that's too big for them to take on all on their own, then that's when, we hope, and they do, call us to get involved. And that's what has kept us so busy. But they're doing those exact same things. They're just, driving around their market, doing mailers, marketing, contacting brokers, and finding these deals within a 2-hour radius of their home. So the grass is not always greener. You just need to look out your back door first.
Well, then conversely, what would be the worst markets? What markets should you stay away from?
There's 2 in Michigan.
Which one's
without stating them. Well, I think you already know. But we're talking about the downtown areas, that have been decimated. Detroit and Flint have been literally decimated in certain parts and lost 40 to 50% of the population. But that's an anomaly. The only other place that's occurred has been down in New Orleans when Katrina came through, and they haven't recovered from that either. But it doesn't mean we paint a broad brush stroke over the entire Flint MSA, Detroit MSA, or New Orleans MSA, or any that have seen any downturns, because as I mentioned, there's we call it a pocket, call it a 3-mile radius. There's dozens, if not, and depending upon the size of the market in general, hundreds of little 3-mile markets within each one of those markets. And so we're developing a facility outside of Detroit right now. It's in a suburb of Detroit. We're looking at 2 facilities that are in Genesee County right now that are outside of Flint proper. Some of our students bought a facility in Burton, Michigan, which is essentially Flint, and bought it, turned it around, rented it up, and sold it out to a larger outfit, and made did really, really well with that. So those markets are still strong. Again, the only places, are some areas that have gone through what those cities have done. And even, there's towns in Pennsylvania, the Rust Belt is littered with areas that a particular industry has moved out of, and it really hurt, just the population in general has gone down, and the demographics looks horrible, declining population, and median income has gone down, and all those other factors. People don't have a lot of stuff, and they don't have a lot of extra money to pay to store their stuff. So those are really the only markets to stay away from. But those are few and far between, and we're talking about just certain small areas within those cities.
Scott, I know that you're coming to Grand Rapids in February for this conference. It's a rare appearance for you. For those of our listeners who are able to come hear you speak, tell them why they should do so.
Yeah, again, as I mentioned earlier, I wouldn't tell anybody to do what I did and sell everything off just to get into this asset class, because first of all, that would offend people, and second of all, you can make money in all asset classes. But what I would say is, everybody knows what distressed real estate looks like, and I'm assuming that the lion's share of the folks out there that are looking, I know there's developers building brand new, and we'll touch on that a little bit. But everybody knows what distressed real estate looks like, so come and learn about this asset class enough so that you can be just dangerous enough to go out and then recognize it when you see it in the marketplace, when you're looking at other asset classes like houses and apartments. We tell our folks, keep your head on a swivel, always looking for the overgrown bushes, vegetation. Everybody knows what distressed real estate looks like. So if you can see what a distressed self-storage facility looks like, from a mom and pop owner that's not keeping up and taking care of things, then add that to your list of properties to look at and dig into to see if it's something that you could acquire as well. If we're all into income producing real estate, then why not add this to your tool belt, another strategy to begin to look at, especially as when this is going to happen, 12, 24 months, but we're going to head into another correction / recession, whatever you call it. And when the music stops, last time out, Brian, there's a whole lot of folks that were in the other asset classes and apartments and houses. Some good friends of mine that, they're gone. Their businesses were decimated, and they're not around any longer. But in storage, we do well in both ends. And so, I feel that every real estate investor should have one, at least small, self-storage facility to add to their portfolio to keep it solvent, to keep the cash coming in the door if there's an immediate downturn like we saw the last time, or even just to produce some passive income while you're out doing less flips or less wholesale deals, or if the landlording side gets a little bit slow, this is the asset class that'll continue to keep things going.
Yeah, I couldn't agree more. I think self-storage is a fantastic asset class. I've invested in it myself, and I really love it. Everything you're saying rings true from my perspective as well. Mm-hmm. I just want to remind our listeners that you will be speaking at the Michigan Landlord and Real Estate Investor Free Conference and Expo, which is February 21st through 23rd of 2019 here in Grand Rapids, Michigan. It's the largest landlord and real estate investor conference in the Midwest, and you can go to rpoaonline.org to register for free. Scott Meyers, you're one of our featured speakers, and I can't wait to hear you speak about self-storage. I've really enjoyed this conversation and learning how you do it, and I want to thank you for taking the time to talk with me today.
Hey, my pleasure, Brian. Looking forward to coming to see you in February as well.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Mike Murphy at JB Harrison Insurance, helping real estate investors to understand and choose their best options for all their insurance needs. Call 616-868-0050 or email mikem@jbhins.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.